Okay. Now, just as Web3 has changed many of the traditional digital business models, it has also seemingly changed the types of organizations who are willing to fund startups that fit their ethos. To talk about the changing face of VC in Web3, we have Bobby Ong of CoinGecko to lead a panel discussion. Hi, Bobby.
Hello.
Looking bright and sunny. Joining him is Ben Wee of Crypto.com Capital. Also, we have JD Lee of DWF Labs. And Ryan Fu of Delphi Digital once again.
Hi, everyone. As everyone, I'm seeing a lot of people in the crowd. This is third day of the Philippine Web3 Festival. Very happy to see all of you here. Quick intro about myself. My name is Bobby. I'm the co-founder and COO of CoinGecko. Today, I'm very proud to be able to host three distinguished speakers here today. We have Ben, we have JD, and we have Ryan over here. So, today we're talking about the changing face of VC in Web3. We've got half an hour on this panel, so I don't really want to waste much time. I'd like to invite the three of you to maybe tell us a little bit more about yourself and the investments that you do for your companies, and also maybe share a bit more about any specific crypto sectors that you guys focus your investments on. So maybe Ben, go first.
Cool. Hi everyone. So my name is Ben. I work for Crypto.com Capital, which is a $500 million principal investment fund of Crypto.com. Our core business is basically a crypto exchange, and of course, like some of those products include cards, the Crypto.com app, the Crypto.com exchange, and a few other products that basically feed into this whole Crypto.com ecosystem. And we also incubated the Kronos Layer 1 chain as well. So for us, we are basically a principal investments fund running proprietary capital, and we tend to be also very returns focused. And some of the sectors that we've been looking at recently are more DeFi and infrastructure focused at the moment.
Hi, my name is JD. So I work at DWF Labs as the head of partnerships and ecosystem. DWF Labs is actually a high-frequency trading firm that has a VC arm, and so I sit on the VC arm. We are a token fund, so most of the projects that we will invest into will have a token aspect to them. We're agnostic in terms of the chain and the sector that we want to invest into. But we're happy to kind of talk to anybody who is in the early stage and anything up to kind of Series A.
Hi, I'm Ryan. Met earlier. I'm with Delphi Digital, right? So we are a research and investment firm. So Delphi Research is producing institutional grade research around layer ones, DeFi, NFTs, right? And my particular focus area is gaming. And I cover more on the venture side. So I do venture investing in gaming and particularly focus on like game economy design, virtual economies, NFT strategy, and the like. So that's kind of my work. And so some of the investments we've made include YGG, AXS, Illuvium, Civitas, Crypto Unicorns, which is, check out the booth, the merch is very nice. But so that's some of the work that we've done.
Okay. So many projects to show up here. In crypto, it almost seems like every firm is a VC these days. I mean, we have a pretty good example over here. We have someone representing an exchange, someone from a market maker, and someone from a research background, all doing investments in crypto. All of you have a different core function, and I'm curious to hear from each of your point of view, what is the core strategic purpose for your firms to move into venture investing? And what is the value add that you provide to your investments?
Yeah. So when it comes to like corporate investors, I think broadly there are two kinds of corporate investors, right? The first is like strategic-based funds. So they tend to find synergy with their core business, right? And there are also corporate funds that also are very returns focused. So one example of that is, of course, ourselves, right? We tend to be very returns focused. And if you think about what the core business is, right, we are basically an exchange, right? And when it comes to value adding, it's very powerful when tokens basically get the additional source of liquidity that comes with the 70 million retail customers that we have on Crypto.com. So that being said, there's a natural synergy for us to basically invest into token-based projects as a result of us, having that exchange that is behind us, right? But yeah.
For us, for the fund, I think we're very strategic in that we want to provide liquidity for the market. So in terms of market making, what we're doing is actually providing liquidity for tokens. And so for us, we invest in any project that we are able to market make on the token for. We're very strategically aligned with the projects because then it means that we have an incentive to make sure that the projects grow and that they're going in the right direction. But apart from providing kind of that liquidity, we're also providing strategic support in terms of like business development, in terms of marketing help, and any kind of advisories that the projects might need.
So as the background is in research, I think Delphi takes a more like thesis-driven fund kind of approach, right? So spending time to do research and sort of diving in, having a bird's eye view of the ecosystem, and across variety of verticals, right? So, and from there we invest into potential new frontiers, right? As ventures team tends to do. So some of the examples of what we put out around gaming, we put out our theses like future of crypto gaming. It's a 40-minute read, and we discuss like potential new monetization models for gaming, right? In the gaming context, but. Another part of our value add is also just working with teams on the token design, right? So we've worked with teams such as Synthetics, right? Aave, YGG, and XE, right? In order to help with the token design. So that's just some of our value add. Yeah.
Yeah, cool. I think it's pretty obvious. We don't want to. We got to talk about the elephant in the room, right? The implosion of FTX. In light of recent events, do you guys see any added risk for founders in raising money from non-traditional venture sources? For example, FTX Ventures collapsed in a pretty dramatic fashion last week. Do you see that your firms are at a disadvantage, or you see this as being advantageous to your firms with the recent implosion?
Yeah, so I think when founders kind of speak to like venture funds, right? I think as much as they're trying to evaluate whether or not they should be investing into these founders, I think the founders should also evaluate, what the corporate investor or like the investor is all about, right? Are they solvent? How's their kind of like IC processes? What's the kind of value add that they have, right? So that being said, I think it's important for them to basically do due diligence on investors as well, right? I think going forward, as you have rightly pointed out, right, there is like a lot of skepticism around like Web3 right now, right? So I think even more so like Web3 funds, especially like players like us, right? There was a lot of recent FUD, so we have to work doubly hard to basically make sure that some of these founders that we want to work with understand like what's the situation about with us, and that we are solvent and what are the value adds that we can provide, right?
Yeah, I completely agree with the sentiment. I think the founders definitely need to look out for what is happening in the market, and definitely do a little bit more DD on who they want, as a part of their portfolio. What kind of value add services that you have with the VC that comes with the check. Because sometimes I think that when capital is cheap, a lot of people think that you can just fundraise a lot of money, you can inflate your valuation, you can bring in the capital, but at what cost, right? You need to kind of figure that out and work out what the roadmap is in order for your company to succeed. I think that for whatever happened over the last couple of days was obviously a huge impact on the market, but now is a really great time for builders to build and to also, be aligned with companies to grow.
Just more time, right? There's more time to like look at things, underwrite the risk, do due diligence, reference checks. Just more time to do that. So it's different from like the bull market times, and then you get also a lot more serious founders and investors as well. So I think that's probably one upside.
From a founder's perspective, I'm curious to hear from you guys. I mean, there's so many sources of funding to tap on these days. Historically, founders can only tap onto very traditional venture firms, and those firms are typically based in Silicon Valley. But these days, venture firms are all over the world, and we also have many different kinds of ventures funding sources. I'm curious to hear from your point of view. I mean, you kind of briefly touched about it. What's kind of your advice to founders when planning for their fundraising journey? And this can be from like pre-seed all the way to Series A, Series B, but I'm sure you guys have some advice. Would be useful, beneficial to some of the founders listening in to hear some of your advice.
Yeah, so I think when it comes to like looking at ventures in the US, typically how it works is that in earlier stages you get let like guys like Andreessen and Paradigm come in, and then subsequently your strategic partners like exchanges, market makers, ecosystem funds come in after, right? So I think this is quite different from like how capital markets kind of work in Asia, right? I think in capital markets in Asia, basically how it works is that whoever you like and you think that there's a value add, you basically fit them into the cap table. But that being said, cap table construction is very important, right? So let's say you're building on like Polygon or like Avalanche, right? I think it's important to get like an Avalanche ecosystem fund to be involved, right? So they're invested in the growth that you have. It's important to get like exchanges to basically have a first look at the token when it comes to investing, and then pass some of this due diligence onto the listing teams after that. Important to get like market makers and other strategic like investors into the cap table as well, right? So that being said, cap table construction is still very important, and of course there are like geographic kind of like nuances to how we do things in the US versus Asia.
I personally agree with that. Sorry. But also, I think that in terms of capital and where people are raising right now, I think the founders really need to think about the valuations of their company. I think traditionally, and what has happened in the past, is that there's been hyperinflation in terms of what capital was and what the valuation of companies were. A lot of these mega funds had, billions and billions of dollars to spend, and so you would get people coming in with a Series A and raising, $300 million on a $2 billion valuation. But what did your product actually do, and what was your project actually, doing? Nobody knows. And so I think that that's something that people really need to plan for. Never go in and inflate valuations just because a fund comes and tells you, we have to write checks of X amount of money, and so this is, this is how you would get us in. I think it's very important to look at what stage your company is at. So if it's at a seed stage, then you want to have just enough money in order to survive and in order to have a run rate that is healthy for your company, but never over-raise and never inflate things just because people tell you to.
So I'll take a slightly different tact to my advice. It would be more on the evaluation of potential partner side of things, right? And Bobby, you're right that there's like a lot of different potential like capital sources that like teams can go for. I think the major thing to look out for is don't trust, verify, right? So you verify with the startups, right? Because the startups that, they're portfolio companies that the venture company has invested in, right? Speak with them, get a reference, an external reference, and if you have that energy to do it, because in the long run, you're going to be with them for years, right? That's sort of the plan. And yeah, you should know who you sort of partner up with.
Yeah. More like who you're getting married with, right? With this VC firm. So you don't want to be married with SPF or Alameda. It's very hard to go through the divorce proceedings right now. And I'm not a VC over here, so I can't talk about it. I think for founders out there, so one of the things that is useful, I would say, is to, before you take any checks from any VCs, always ask for a reference, either from the VCs. Obviously, the VCs are going to give them a contact that will speak very favorably of themselves. So take the call, jump on them, ask them how the VCs have helped them or have not helped them, how they're helpful or not helpful. But also go through the list on like Crunchbase or TechCrunch. What are the other companies that have raised from these firms, and either get yourself introduced to this team directly or indirectly, or from the VCs, and have a chat with the founders and get your feedback. So if the VCs are good, they have nothing to hide, so they will happily do the introduction. But if there's something to hide, they'll probably make up some excuses on why they can't introduce you to a certain founder, and that's probably a red flag. Fair? I've got one question that may be a bit challenging for you guys, right? So we talk about how, you talk about if you are planning to build on the Polygon ecosystem, it probably makes sense to raise from the Polygon Foundation. If you plan to use a market maker, raise from its market maker. But what if, you raise from the Polygon Foundation later, or from your case, raise from Crypto.com capital, but then realize that, Chronos or Polygon is not a good use case, and maybe Avalanche is a better blockchain to build. I don't know if you have seen any such situations happening with other firms, with other companies, startups, and what's kind of your take when firms have raised from certain ecosystem partners but chose to work and operate on a different ecosystem?
Yeah, so I do think that if you've accepted money from like a particular ecosystem, that doesn't mean that you should. Because I mean, nowadays, like most dApps are going multi-chain anyways, right? They can integrate more than one chain. So I've not seen an instance where they raised money from like a particular ecosystem and then decided to pivot completely to building on another ecosystem, because it just doesn't make sense. I mean, if you're getting like an investment from Polygon, for example, I'm sure the Polygon team would be more than happy to basically support you on like some of your development kind of like needs, right? And then supporting you with like launching, marketing as well, RTing some of the things that you're posting on Twitter. Like those are some of the soft things that basically can signal confidence in your project coming from an ecosystem, right? So that being said, it's still very powerful to get ecosystem support.
I think that for us, we haven't really seen that use case either. But I think for founders in the room, that if you guys are unsure about what you're building and where you're building, then maybe you shouldn't be building it in the first place. But if you are, then please do your DD. Make sure that you're building something, that you want, and that you understand, the inherent risks that come with it, and that you're building on the chains and on the platforms that you need to be building on.
Yeah, so I'm a bit more contrarian. Like, I think, power to the founder, if they decide that they want to move their business, and there's a good strategic reason for it. It's not because like, all right, I wanted to spy, Polygon or Chronos, right? So, they have a reason for it. I think you can always work it out, right? And there isn't like an obligation. There could be, right? So I think, in practice, term sheets can be really flexible. Right, so it could stipulate, like, for example, tranches of funding and the like, right? But that's going a bit too complex or too detailed. The point I'm trying to make is that in the end, there's still alignment from an investment perspective. And for example, for a returns-driven fund, just because it's not building on Chronos doesn't mean that it can't be a successful business. It's just that the incentive for them to help, and I always think in incentives, right, might not be as strong. Yeah.
So we probably have about 5 minutes or so to go, and then I'm going to ask one question about the outlook for next year. So a couple of things you've mentioned today, a couple of things changed. So like this year, we've seen the crypto market went down. So what used to be a founders-led market, founders get to dictate term sheet, raise at high valuations. Obviously, I think that has flipped to the advantage of VCs these days. Interest rate used to be 0 or negative in some countries. Interest rates are now at a high, are growing. So obviously, for things have changed. Curious to hear from your take. What's your outlook for next year? Do you see fundraising slowing down significantly? Or do you think that there's just so much money sloshing around in VCs' pockets right now? There's just so much dry powder waiting to be deployed and just waiting. It's just a case of waiting for the right place, right time, right team to come on place, and then the fundraising machine is going to go crazy again.
Yeah. So I think this year what you saw was like your Luna into your Three Arrows, into your Alameda and FTX, right? So it's been a very tough year, not just for retail investors, but also for institutional adopters of like crypto, right? So that being said, when you think about what the thesis for crypto is, right, it's basically adoption, right? So you have like retail adoption where people are no longer interested in really looking into crypto investments at the moment, plus also like institutional players being a bit less aggressive in terms of their push into coming into crypto. And as you rightly pointed out, there's a very aggressive, like a very hawkish, like Fed environment right now, rates environment, right? And all these things will kind of contribute to my view that I think next year it's going to be slightly slower. I think not just for fundraising, but also just the economy in general, right? So we'll see, right? I think it's going to be a slower few months. More layoffs coming, not across the industry, across the Web3 industry. But by the next cycle, all of us will be OGs, right? So.
I think that, yeah, this is definitely going to be a slow couple of months. I think everybody needs to be sure that your treasuries and that your companies have enough run rate to last until at least next year. Any good projects out there, though, we have funds that are still funding projects. And so please, reach out if you guys are a project that is fundraising right now. But I think that in terms of the check sizes and also the speed of execution for these, there's going to be a lot more in terms of due diligence that is done. There's going to be a lot more discovery that's going to be done. And in terms of the speed, I think before you were able to fundraise, a couple of $100 million in like a week or two. Now you're looking at, maybe 9 months in order to get a fundraise complete.
So I think just to round out and add to what you were sharing, right? I think the additional time to due diligence and research the companies allows you, both sides, to build more conviction about each other, right? And so I think one consequence of that additional conviction is the willingness to invest far more into individual companies. So we're seeing this dynamic play out even in more recent rounds, right? Where one or two venture firms might have a really strong conviction and they're very willing to take 80% or 85% of the round, whereas like the dynamics in the past was more like 20, co-leading rounds together, right? And so now there's a lot more, I guess, thesis-driven investing. And when you find a good match, it's really a good match, Yeah, it's no longer swiping right, it's about getting match made. Yeah.
Yeah, I guess we'll probably see less party rounds, more convictions from VCs, a lot longer, slower process to fundraise, harder for founders to raise money. But yeah, I think it will be a challenging year. So if you guys are fundraising, find your right fit and talk to the investors, relevant investors. All right, I guess that's all the time that we have for today. I just want to say thank you very much, Ben, JD, and Ryan for spending your time to talk to us today. Thank you very much, guys.
Thank you so much, Bobby, Ben, JD, and Ryan for that interesting panel.